All right, ladies and gentlemen, I got your watch list coming in October 17th, 2019, and the stock market is about to get volatile. We just had Netflix earnings. That was crazy, as well as IBM. I'm going to go over the plays that we made. We kind of made some big plays, and some are still on the table, so I want to talk about that in depth. I'm going to try again what we did yesterday. Broke down the plays a little bit more here, and then we're going to talk about some potential plays. I have a few things, and it's all in line with this strategy of just looking at where we're at with the market and what could potentially make it volatile. Now, the key moving forward from here is earnings is now starting. We've got Netflix earnings. We had IBM. However, there could be some move. We got to watch some of the key factors like the yuan. If anything does develop negatively, there's still some of that geopolitical stuff, even the impeachment stuff lingering on the surface, as well as the China deal and any of those tensions that could be created through anything else. But at the end of the day, what is going to make the market volatile is now report after report coming in next week with some of these bigger companies. You're going to start seeing moves, and it's going to be a different type of volatility that's going to take some getting used to, or you might not be used to. Again, it doesn't have to be these quick run-ups, but it's in these lower volume days, these bigger pushes up and down. But again, it's earnings, so it has the effect to push the markets up and down, and then as well affects certain industries. So even then, Netflix had a report, and this what's making me even say this is that you saw an interesting reaction across the board after hours, especially when a company like Netflix does report, and kind of the nature of it. Because now moving forward, investors are going to start kind of taking into account what they're expecting from earnings and how some of these companies have reported relative towards their estimates. So it's going to be crucial. It's going to be a mix of being patient, and then also we're going to talk about and kind of, well, you guys are going to see the results of the play, knowing when to strike to a certain degree. So let's not waste any more time. You guys know what you need to do. Drop your thumbs up on the video. Make sure you're subscribed, and we are live Monday through Friday, 30 minutes before open. It's the first link in the description. It's pinned in the comments. We will see you here in the morning, but the most important thing you need to do, post your watch list. Let us know what you played, if you played anything on earnings, or what you're looking at for tomorrow, or anything else for the earnings season. But right off the bat here, so those are the potential plays. We're not going to get there. I'll keep it simple. There was some news today. There's going to be a few things that we should be looking out for, but at the end of the day, just watch the currencies to really confirm anything with Brexit or anything else, and then keep a close eye on the yuan. This is what's kind of making me be even a little cautious towards this week, was the weakening that we saw yesterday. So just keep your eye on that, and we've talked about it. But as far as what to focus on this week, because now earnings for this week are pretty much done. There is a few companies, and they could give effects and even maybe give us economic signals, but those are going to come after the fact. We're not really focusing on the plays there as far as, you know, big movements and opportunities with options and what we could see out there. The key is watch for the continuation here. You're going to have earnings plays like Bank of America, JP Morgan, and the moves afterwards are sometimes key. Even tomorrow with Netflix, really where it's at now is telling us one thing, but where it opens at in the morning is another, but then how it moves. Same thing with Bank of America, as well as even IBM, and IBM sticks out really, really big for tomorrow in that sense, because they did drop, and that was even one of the plays we made today. But again, they had one of their worst earnings in years, so this is one where 5% is a big move, but how it continues, it may not even move that much after hours, and you could get the bulk of the move during hours. And again, also, I don't even have much to even tell you guys on Netflix for the earnings, in that I didn't listen to the call. I just looked at the numbers, and it was just a mixed bag, and I wanted to see the reaction. But we will get updates, which is why these companies could move, and it's going to come from the upgrades and downgrades. So if any analysts are covering it, but watch for that, and then watch the contracts in the morning. Sometimes that first 10, 30 minutes, a lot could be done there. Or that's where the bulk of the move has to happen, for that matter. But there's that. As far as the plays of the day now, this is what we actually played. I did 2 plays, and this one was kind of a bigger play here. And I did 2 earnings plays. I did this one like last second. I was debating it, but I was like, you know, I was pretty confident that Netflix wasn't going to move too much, and it did move. I was pricing in the $15. It ended up moving 30, and some people were even saying, you know, they priced in both the top and the bottom of the calls and the puts. I don't do that. But even then, I was also including this run up here. So I thought that was a pretty big move. I wasn't expecting it to move too much. So we did 2 different plays in this first one. This one is a weekly that expires tomorrow, and this is a short straddle. So I know we use this sometimes. We often misuse the term straddle. I mean, I think it just makes more sense to describe buying options on both sides. In this case, the real difference between a straddle and strangle is the space between the contracts. So in a sense, this was a short straddle, but you could also call it a short strangle too. But the key is we went short on both a call and a put, and the key is to collect the premium. And essentially, again, like any of these premium sales, we want them to expire worthless. So I'll run you through the math on this and really where we're looking for by the end of the week to make money on this. So I sold the 302, and then here's the key. Let me tell you this. You could tell here because I'm shorting it, -1, there is no collateral, although you do need collateral to make this trade. But at the end of the day, this play holds a theoretically unlimited risk. So you could be exposed to a lot. On one contract, it's kind of defined in a realistic realm, but you got to be careful of that. But this one, we shorted the 302.50 call and we collected $944, and then we shorted the 272.50 put and got $929. So think about that. If we short the 302.50, we want this to expire worthless. So that means, here, let's get this up here. That means by Friday, we want this stock to pretty much close below here or literally right at here. Because again, if it did close at 302.50, even right in the money or $1 in the money, it would have literally $1 of value, but we collected $944 on that in the put, we would get essentially the max gain. So you theoretically want it below here, and then we shorted the 272.50 put. So you want that to expire. So that means we want it to end above here. And that's kind of what I was saying there. And you could see, even though it went up a lot, I was expecting, they reported, I figured they'd probably go up to 300, maybe give or take some, and then come back down, but they wouldn't go down too much, you know. And again, I could have been wrong, and we were wrong in some instances, but the key is we have the next few days, and now the next thing you need to factor is the total credit. So even though I want it to stay below those prices, that is just saying to get the max amount of profit in that play. As far as the break even, that's different. And that's where kind of we've talked about, and we'll cover it even on the Iron Condor. We made this one on the Robinhood. I'm going to explain that one. But the fact is, you now get to factor in this $18 of credit. So if I got that credit, that's also acting as a buffer to my max loss. So again, your max loss, there's no such thing as a max loss here if you think about it, because we don't have it capped by buying a contract. So it's essentially you add the credit here to your strike prices, and that's letting you know pretty much after that point, then you actually start dipping into your account and taking a net loss. So in this case, even though you see right here, it's at 311, after hours, I'm still winning on that trade, even though we sold a 302.50, so that's above there. But now think again, you want to hold these till expiration. Come October 18th now, let's say, it ends at $311, like literally, let's say right where it is. We'll keep it simple for math's sake. That's going to be worth, that'll be $9 in the money. 302 plus 9, 311. So that contract will be worth $900, but we sold it for $944. So we would be down, it would be worth $900. We got $944. We made $44 like that. But now, if it's at 311, it's not at 272. So this put would expire worthless, and we'd collect the $929. So we'd actually walk away with like $970 profit if it stayed up here. So even though the stock moved 10% earnings, that's the key. But now again, this is a really risky play though, because if it shot back up to like 340, 360, we would still owe money, and there's no way of capping it, especially on a weekly. It'd be tough to roll out and all that. But essentially now the break even on this, you take the $18, add it to the call. So 302.50 plus 18, that's about 321. And that's the top end of where we think, you know, that's pretty much anything after 321, we start to lose money. That's if it closes there by Friday. And then on the bottom side, subtract 18 bucks from 272. It could go 18 more dollars in the money. It's like 253 or something around there. So those are my break-even points. So this play, it's going to be in our favor. I mean, come on tomorrow. We'll see how it values throughout the day. Definitely risky, but in this case, this strategy met more in lines with what I wanted. I wanted to take advantage of the high premium on the earnings. I was willing to expose myself to a certain amount of risk because it already moved up 20 bucks coming into earnings. Even if it did come back here or here, like let's say it did even go up to like 3,500, that would be literally 10 bucks or $14 above the 321 break even. So even if it made up all of the last 3 months and had a monster report, and literally that would be a 20% move on the day, I would be down $1,000, and that would probably be something we could roll over and just keep that and roll that over, maybe get more credit and then just play that out. But I liked it because then if at the end of the week, if I'm right, I can make up to $1,800 on it. And I was pretty certain it was going to move in that range. So I was just a little bit shy here on it. But again, we're going to see what happens. But that play, extremely risky. Understand too, option trading is extremely risky. You can't lose all time. Most for financial investment. Please consult with a financial advisor. It's for educational purposes, and we are a friendly call. Thank you, everyone. But somebody said it. This is something good to paper trade with. So play around with that, paper trade with it. I'm sure you'll enjoy it. But actually, you know, it even reminds me though, even saying this is a play where you could screw your shit up though. If you guys buy multiple contracts and you do it on a cheap stock. So again, it would take a big market cap and a big move to do this on an individual stock. And if you had more contracts, I mean, that could add up. You know, that same example I said, if you did it with 10 contracts, that's a whole different story. So I don't know what your brokers will do or some of the risk you do, but be careful of that. Just keep that in mind. The actual best thing to do these on this type of play where you're shorting the call and the put like that uncovered. Again, paper trade with these and play them around, but the best that most people do this on is actually indexing, because indexes aren't going to move 10% in any given day. So you can still collect high volatility and have your range, but you're less prone to big price moves, which, as you see, that's the only thing that will really upset this. But again, high credit, that's telling you something about the risk. Then this was the play we made, and now this was an interesting play. I did this on the Robinhood account. It shocked some people. It even said, oh, did it fix itself? No, yeah, see, even right at close, it like dropped $100 on that spread. But this was a big risk on the account. Again, we've been taking some losses there. But you guys will see as some of these expirations and rollovers, we're going to walk. We still have a bunch of cash considering the collateral. The best part is we're probably on max gain on a lot of these plays so far. And again, some of them we're going to be able to walk away with decent credits here. But I'm going to take you guys back to the initial strategy. So again, you guys have seen what we're doing with the spreads. You're seeing how we even, you know, the kind of the basics of even using this small account here. But it's going for, you know, better risk rewards and understanding kind of when and how to play. Remember, the market's kind of volatile, not doing much. We want to take advantage of those spreads. Now you got earnings season. That's an opportunity to be able to go and buy something or find something. But like we even said, you know, it's just like waiting for news. You just got to stay alive and wait for certain events and come in here. Now, earnings is risky and a gamble, and you got to understand where to do it. But it's kind of evaluate what you're playing and maximize your exposure, I think, is the best way. So in this case, ultimately, I could have walked away, and that would have been the best thing to do. But then I'd have to weigh, okay, not playing earnings and passing up that opportunity, or staying and trying to play it. It doesn't start with this Iron Condor. It starts with the Disney play. So I swapped the risk on that Disney. Remember, I sold that 131 put and we bought the 128 put. And this one was a rollover. Remember, it was a 131, 129. I went back to see the prices just to highlight this. Remember, that first one, we sold it for $59 credit, and then we lost on it. I think it was worth like $129. So then we were down $70, but then we rolled that over, and then the latest one we had on there was a $169. So it left us with like a $99 of potential credit to grab there, and it was worth $160. That's even what we closed it out at, and I think I closed it out today at like $120, or no, like $70 I think. And we made like $70 total on this play. That was on this Disney. So I walked away. I didn't care, you know, whether or not the rollover, even though we were able to walk away with like $20 considering the last time. I thought we would have took a net loss on that one from the rollover. But again, that one didn't even matter to me. That's why I said the wisest thing we could have done would have probably been just to close it out, and that's it, because I didn't like Disney. I haven't been liking how Disney's been moving. And this is going to be one to watch too, considering what happened with Netflix. Keep your eyes out on that. But see, and it went up after hours, and that's what I sacrificed, because on that play, let's say it did come up, you can see it came up there, but I haven't been liking how it's been moving. And I didn't like that play being October 18th, because really how Disney's been, it had a lot of trouble getting above here. And if anything happened with Netflix and their bad earnings, I was figuring, well, Disney was going to get clapped anyways. That contract expires in 2 days. And if it drops before, it has a wider risk. You know, 128 to 131, that's a $300 collateral, and we got like 160 back on. So in my mind, it was still, again, even if Disney dropped, I still had that like $300 or so risk on the table. And it expired on Friday. So what I did with that is I closed it out early. There was still like $60, $70 of profit I could have made on it if I held it and if it held up over at the end of the week. But I didn't like the risk reward on it and everything. And I figured, this is where I was saying, go to a better opportunity. And that's what made me select this. And even with the scale now of which we did it. So this was an Iron Condor. So if you guys aren't familiar, we have a video on that too. But it's just selling 2 credit spreads on the same expiration point. And again, kind of like this play, it's honestly just like this. Like this one, but you bought your protection to protect yourself, and that cuts into the margin here. That's why you get so much money by taking the risk on the back end on this one. Smaller accounts, if you don't have the money available to do it, you got to cover the spread, but you could still do something similar. But what we did is we sold 5 295 calls, bought 5 297.50 calls, and then we sold 5 280 puts, and bought 5 277.50 puts. And now the net credit for each one, even though I did -5, if you just did -1, the net credit was $210. Max risk between any of these strikes is 250. Your max risk max risk is $250, net credit $210. Your net total max risk on that play would be $40 per contract. So I did 5 of those. That literally only requires now a capital of $200, which is lower than the Disney play. But now my collateral is $1,000. So if by October 25th, essentially, if the stock stays above 277.50 or below 297, we would make that $1,000. And now, where did I get those price points? Oh man, it's running up there. But tomorrow's going to be interesting because we were here at 386 at close, and this is what I waited to. It was like 386.87. I looked at the calls and the puts. I was saying the market makers pricing in $13. I think it came out to like 14 or 15 by close. So at 286 plus 13 would be like 299 on the high side, and then on the low side that would be 270. So what I did was I kind of used that as like my guidelines, but I pretty much thought that Netflix would have been pretty disappointing, and again, we might still see that, but the key is now too, we have the time on earnings, and that's not uncommon for Netflix to report, have a continuation, whether it even be up or down, but that's why it gives us the next few days and all of next week. Picture that Boeing play, you know, it's about, this is where you could kind of time it. Like in this case, you could kind of see how it moved and what would happen throughout a week. It's kind of the similar situation where I'm saying, hey, it's going to come up here, it's going to hit some high or come lower. And again, if it does go past our range and leave us in the dust like it has on some of the other spreads, with not enough time we'll lose. But with earnings and all that, I took that as being in my favor to have some advantages there. So that was the play and the logic, and we'll see how this plays out. This one's going to give us till next week. This one is going to be for this week, so where it moves in the next few days will be more critical to hear. And this one, you could give it some time, but it might even be up tomorrow too. It all depends. Or with the Iron Condor, even if you are down, again, hopefully you didn't get too crazy on the risk, but the Iron Condor, it'll start increasing in value. Same thing with these ones, the closer towards expiration. So you'll see how this one will play out, because, you know, you got to give it time to oscillate and let the premium go from the contracts. And again, too, don't forget to factor in your net credit to the top end. So you sold the 295s, that's where you'll start to lose money. You pretty much have your buffer zone of $2.10. So our break even on this one is about like 297 something. And then the break even on the bottom here is like 277. So you only lose that 40-cent difference, worst case scenario. And that's why, too, this was good for earnings, because it let us get this week, still create a decent, you know, $10 range on the stock and collect such a high credit. But that was about a 20% probability. And then this play was actually a 62% probability. So there's that. And then the last play we made was the October 25th 125 put. Only got one of them, just looking for a Grim Reaper, and people asked what I meant by that. And I said this, and we've talked about it, is pretty much something like this, but even bigger, where I'm looking for a big one-day market cap loss off of a real just shock that kind of just comes out of nowhere, where it's not really too expected, and it takes stocks down. An example is like Facebook. After that one earnings, you know, they dropped like 30-40%. That's what the Grim Reaper is. It'd be like a 20-30% move. So that's why with IBM, it was a 5% move down in the first candle. It's still kind of trickling a little bit there. We'll see how it is, but their earnings was bad. They had no taxes, and they still missed some issues with the Red Hat thing. So this is going to be an interesting one tomorrow, and I'd really watch this one out in the morning for the continuation, but those are the only plays. So it took a long time, but I figured, you know, for Netflix, you guys are going to be interested. And now also too, watch for the continuation. You could apply the same strategy on there tomorrow, and I might even look for that, or even setting up another Iron Condor at a certain range, or even selling spreads depending on how it moves. But we will see. But hopefully this kind of could show you guys, you know, with options and how it's going to play with earnings. You guys could learn, again, whether I'm making money or losing money. But then also, you know, try to analyze what plays you're holding and justify your risk, or try to understand, is it worth it if you're going to take the same exposure, kind of like with the Disney and Netflix. You know, I was essentially able to cut down the max risk and 10 times the credit with an extra week. So kind of put that into context there. I told you guys about this yesterday. You guys liked it. The potential plays for tomorrow. Again, these aren't plays I'm playing. They're just ideas I had. You guys could learn from them. I might buy them tomorrow. If I do, you know, be on stream, you'll see it. But these caught my attention, or these were something I'm interested in. Nothing too crazy. And again, it's just going to be looking at the Netflix Iron Condor depending on where we open tomorrow, and seeing, you might be able to set up a wider range or change some things around. Now that it's high, you might be able to sell an Iron Condor and just sell expensive calls and then cheaper end on the put to widen the range and go from there. Or even, again, even a continuation with that. And then lastly, it's going to be value and momentum rotation. You know, those are having big moves, and they're swapping. It's having that rotation between the two, kind of like we saw a few weeks ago when Roku started dropping. But essentially, everything's going to be moving on plays for earnings. So there's going to be some individual names that we might be able to play for this week. Otherwise, everything will be pushed into next week. And with a big earnings week, some things are going to be moving either all the same or the pricings are going to get affected. So if you want to play anything for this week, I only have 2 plays that I came up with that I really like, because everything else, I was just looking at Netflix all day today. I'm looking at Amazon. I have a play I want to even look at even with Facebook. I think even right off the bat for next week, considering how not too many things moved off the Netflix report after hours, but Facebook moved up a ton. It's already really making a big move here. If there's gas off of tomorrow and the market eats up Netflix and everything, and we get good news and this starts to go and break out there, it might be good to sell some spreads into the short term, or sell some put spreads and let it just kind of run up into earnings and go from there. But you got to be careful. Sometimes that's the scary part. This is what makes earnings so psycho, that sometimes it'll have this big move, but even if they report next week, it might drop the day or two before pretty hard because it's already ran up so much. Again, this is people pricing in and anticipating. Options are moving everywhere, so keep that in mind. And so those plays, so again, like plays even like the McDonald's, and the HD is one of them, but like even McDonald's fell out. The money, that one I was talking about yesterday, that one went up, I think, already like 40-50% on there, but this HD was on there yesterday, so I'll even start with this one. As far, and again, just for the end of the week, otherwise I'm going to be looking at other companies, but HD October 18th credit spread, sell the 235, buy the 237.50. It's a net credit of 124, so your max risk is 130, but I like it because compare it to yesterday's Home Depot, I said the 232, 235, and that play was up like 40-50 bucks today, but then it fell out the money as Home Depot bounced. So it started to come down, and see it was right there, $1 away. It went up in value because the credit. But putting that into context with yesterday, I like that play, and now both of those are still in play. So that play went from like 150 yesterday, around like 180, to like now I think it's like 196 to something, even a little higher. So you could sell the 232 and get a higher credit than yesterday, but it's going to be further out the money. Or now this one's approaching similar to the credit as yesterday, but now it's way easier for this thing to fall out of 235 because it's just grazing there. But again, you have to see HD's holding up some momentum. That this is why I want to see that rotation and how things play out this week, and that could give us some signs also into what to pay attention for and how the market's positioning itself. And the other one is Tesla. I think this one's good for the credit spread just because literally you can see how many days it's been running up kind of nonstop. This 265 area is going to be huge. So again, the premiums are going to be somewhat higher. And I was looking at these ones all throughout the day. We even talked about them on Monday. And they're just crazy how they're moving, and they're still holding value, which is both good and bad. You know, Tesla's risky in that sense, but it'd be selling the 265 call, buying the 267.50 call, 50-cent credit, but wait for it if it makes a big move up there. Because again, tomorrow's going to be Thursday, right before. It's still offering the credit almost at the beginning of the week, but these were as high as like 80, 90 bucks. I think even a little higher today. So they'll go up and get momentum as people get excited, but then they will quickly deflate. So these could even be good ones to flip. You maybe even do a few. You could do a trade today, exit tomorrow, and then do another one. Who knows? But that is pretty much it. So those are those plays. I don't want to drag it on. That took a lot of time there with the Netflix. So watch everything else coming into next week. Netflix and IBM are going to be the main ones tomorrow, along with like the values, BA, HD, Donald's, and really watch Boeing and kind of the range it's in there with even those plays we talked about yesterday. And then JP Morgan and Bank of America, again, continuation with like honorary mentions to NVIDIA and UNH. NVIDIA kind of dropped there, so watch if there is any positive effects. And then UNH and kind of the healthcare. It's been holding up, and if there is any sort of sector rotation, these guys have been beaten down and could use some love, so watch them and Anthem as well. Oh, and then Disney and Roku as well, too, as a result of Netflix. See how those have an effect. And then Amazon, we have that credit spread. And if Facebook does good, I want to see how they interact between them and Apple and them and Facebook. But watch for that earnings pump there. But it does look a little bit weaker here. But again, how IBM did and what happened with their cloud, that could either be it could be a positive if people shifted towards Amazon, or if it signals anything negative at Amazon. We'll see how the market takes in. That could be bad. And then Tesla. And that is your watch list, ladies and gentlemen. So be smart with these plays, post your plays. Make sure you guys are hydrated, healthy, ready to go. I'll see you guys in the morning. It's earnings season. I need y'all in the game. Pay attention. Imagine doing all of this stuff and then giving up right before the big earnings are here in the end of the quarter. Don't let them pump fake you. Don't let them juke you. Let's go. Cockroach. Be hard to kill. Do your thing, baby. And the Colt loves you, baby. Let's go.